Well, y'all, we've made it. Chapter 18 Tax Reform Proposals. After spending the preceding 17 ish chapters discussing what comprises our federal tax code and federal tax regulations, now we'll look at what's wrong with it and some of the proposals that could make it better. The tax policy refers to the tax code tries to impose. To address this fairness issue, the United States has a progressive tax system. This means that as a person's tax base increases, they also pay a higher tax rate. Now let's look at how this is illustrated. Professor T, the graduate student, earned $22,750 as a research assistant at Texas Tech University. On this $22,750, my total tax liability, before taking into consideration the standard deduction and other deductions, would be $2,500, representing an average tax rate of 11.2%. Professor T, the grad student, falls into the 12% marginal tax bracket. But now let's assume I've successfully gotten my degree and now work on the tenure track at a major university. My total tax liability, again, not taking into consideration any of the deductions or credits, would be $18,289. This represents the 24% marginal tax bracket and an average tax on earnings of 18.2%. Kimmy T on the tenure track pays an average tax rate that is higher than Kimmy T, the graduate student. Now that we've discussed what makes for a good tax and the policy standard to which the United States Federal Tax Code aspires, let's look at some of the ways in which our current tax system falls short of the mark. The first way is its mind-numbing complexity. We've spent a whole semester learning how to research the tax code and the federal tax regulations, and we know that they're complex and voluminous and subject to interpretation. Second, the tax code is costly to comply with and costly to administer. Anytime the tax code changes, there's a significant increase in the cost of complying with and administering the tax law. Just to give you an idea, on average, Americans spend 6.1 billion hours preparing their income tax returns. They collectively spend $168 billion to prepare taxes and conduct tax planning. While this burden falls primarily on businesses, it's also costly for individual taxpayers as well. By one estimate, up to 60% of taxpayers use a paid preparer, and more than 90% of taxpayers use a paid software application. fourth shortcoming of our tax system is the fact that the underground economy is untaxed. Despite the IRS best efforts, the current tax system is easily manipulated. If cash gets paid and documents aren't recorded, the IRS has no record of that income being earned and can't tax that income. Because of this, the IRS fails to collect all taxes that are actually owed. This disparity between what should be paid and what was paid comes from three primary sources: non-filing taxpayers, who are required to file a return but do not do so in a timely manner; the underreporting of taxes, either by understating income or overstating deductions, exemptions, and credits; and underpayment, where taxpayers file their returns but fail to remit the full amount due by the payment due date. Of this, about 80% of the deficit comes from underreporting. A fifth shortcoming of our current tax system is the fact that it biases against saving and investment. Our system taxes interest and most other returns to capital. This could actually have a trickle-down impact on capital investment and job creation. If taxpayers are not making investments in business, this limits a business's ability to purchase equipment as well as create jobs. However, this bias is at least partly mitigated by preferential interest rates on capital gains and certain types of dividends. Finally, the sixth way in which our tax system falls short is the fact that it potentially puts us at a global competitive disadvantage. United States corporate tax rates are high relative to other developed and developing countries. This can create a disadvantage for companies trying to compete globally. The Tax Cuts and Jobs Act of 2017 sought to address this by lowering the corporate tax rate to 21%. So now that we've identified some of the pitfalls in the current federal tax system, let's look at some of the proposals that have been tossed around to address these shortfallings. One method is the value-added tax, which is popular in Europe. This modified consumption-based tax levies tax at each stage in the production cycle based on the value added. Value added is computed as the difference between the value of a taxpayer's outputs and their purchases. Some of the pros of the value added tax structure is that it encourages investment and savings by taxing consumption rather than taxing income. It would avoid the application of the code potentially by eliminating the individual income tax, and it would bring the underground economy into compliance, which would make it an efficient tax. However, the value-added tax disproportionately impacts low and middle income taxpayers who are forced to consume the majority of their income. This is a regressive tax. It would also carry a high startup, transition, and administrative cost. Another question that must be asked: if the U.S. were to adopt a value-added tax, would it replace the income tax requirement or would it complement the income tax requirement, adding another tax burden? The second proposal is to add a national retail tax. This would impose a sales tax on the retail price of final goods and services. The pros is that a national retail tax would have lower startup and administrative costs relative to the value-added tax. Most states already administer a sales tax. It would also have lower business compliance costs than the value-added tax because only the final sale of goods and services would be taxable. However, the national retail tax is regressive in nature, and it would be easy to evade if you can avoid spending, as higher income taxpayers can. You can avoid paying this tax. to some extent. Another question is whether the national retail tax would replace the income tax requirement or complement it and be another source of tax. The flat tax levies a single tax rate on income, generally accepting investment type income. This would result in the elimination of the Internal Revenue Code in favor of a single personal and business tax rate. This would also eliminate most deductions and exemptions. The pros for a flat tax are its simplicity. It would result potentially in the elimination of the Internal Revenue Code and eliminate most accounting method issues by making most business expenses fully deductible. It also encourages investment and savings. However, a flat tax would have to be fairly high to be sufficient. It's also a regressive tax, as taxpayers who benefit from these deductions and credits would end up paying more under a flat tax system than they do under our current progressive system with the established deductions and credits. It would also deter certain purchases, such as charitable giving. Most charitable giving comes from individuals who earn enough and can take advantage of the itemized deduction process. And finally, a fourth proposition is the personal consumption tax. This would tax what an individual consumes by calculating a person's income less everything that they put towards savings, meaning investments, while counteracting the effect of taking on debt to make investments and to augment one's income. The benefits of a personal consumption structure is that it would encourage saving while discouraging consumptive debt. Savings implies investment, which would have a trickle-down effect for businesses as well. The personal consumption tax could accommodate a graduated tax structure, as in our current tax system. However, a personal consumption tax would complicate individual tax reporting. Persons would have to save a great deal more documentation on debt acquisition and savings than they currently do now. It could also magnify reporting, monitoring, and compliance issues beyond what currently occurs. Now, before we move on from Chapter 18, let's do 2 quick comprehension checks. First, the blank is the primary source of revenue for most European countries. Well, if you've ever traveled abroad and taken a look at your receipt, you'll see that the value-added tax appears at the bottom of each one. The value-added tax is the primary source of revenue for most European countries, D. Finally, because low-income individuals have little choice but to consume most of their income, while wealthy individuals have the wherewithal to consume much less, a national sales tax would be regressive. It would hit persons coming from lower income brackets more harshly because they spend a higher percentage of their income on consumable goods. Well, y'all, it's been fun. It's been real. It's been real fun. I've enjoyed walking with you through federal taxation and learning a little bit more about it myself. Thanks for making this an enjoyable learning experience all around.